Hey everyone, this is Christine,
And Lauren.
and this is our Zoom stock presentation. I'll be playing the bull.
And I will be the bear.
So, if you've lived under a rock and have never heard of Zoom, Zoom is a leader in modern enterprise video communications with an easy, reliable cloud platform for video, audio, conferencing, chat, webinars, class sessions. So, before we get into the graph, if you haven't checked the stocks today, as of today, at the closing bell, Zoom's revenue jumped all the way to 367%. Revenues came in at $777.2 million versus the expected revenue of $693.4 million. When we took the screenshot of the graph, stock was $439.60. This morning it was up to $475.98. This is a high beta, high growth stock. Zoom shares are up 74% this year, while the S&P 500 is down 21%. As you can see, from September to November, Zoom stock has really skyrocketed up. It came a little bit down, but it's hit its pretty high peaks, which is due to the pandemic, and it's become more of a necessity in everybody's home than something of leisure. It kind of hit down the down mark when the vaccine was announced that they were 98% on the go for it, but 40% of people reported that they won't take the vaccine even once it's available, and it's still not available, so it is still trailing in the upward direction. The revenue growth was actually just from the demand and the execution of Zoom.
So also today when it was closing, I'm going to talk about like why people are talking about the stock actually going down when they thought it was going to go up. So today when it was closing, the reason why the stock went down was because it was being driven lower is because of cash and cash equivalents. And that was of $735.5 million versus its estimated of $1.05 billion. So they are missing the marker by about $270 million. And then the cost of the revenue also was $258.7 million when it was estimated for much lower. So cost of revenue is higher than expected, and right now in aftermarket trading, it's only down about 4.5 to 5%, which really isn't that bad when they were projecting it to be higher. But so they're just down on their 1-year target estimated per share. They estimated it to be at 474.85, and today when the market closed, it was at 471.61.
Okay, so here's Zoom financials. I think they kind of speak for themselves. But in Zoom's latest earnings report, they basically crushed it across every level from a revenue standpoint. They have a strong balance sheet, low debt, good end cash flow. So I think it pretty much speaks for itself. So here's why I think you should buy the Zoom stock. Zoom is currently trading higher than its 50-day and 200-day moving averages of 304.66 and 178.66 respectively, indicating that the stock is in an uptrend. Zoom recently added nearly 988 customers, contributing more than 100,000 to its trailing 12 months revenue during the last quarter, growing about 112% year over year. Zoom is currently rated number 3 out of 53 stocks in the technology service industry. It's been popular during the pandemic and has gave individuals, companies, schools a safe way to have meetings. Sales growth expected for 2021 is to be up to 284%. Profit margins 71 to 72% in 2021.
So the target investor profile, when looking for someone to buy this stock, that's going to be somebody who wants a high return on a high risk. It's also a newer stock, so it's not a blue chip. Again, high beta, and it also does not pay a dividend. I personally like to buy stock where I get dividend checks, but This one, they just don't give you a dividend. But significant news, according to CNBC, in addition to beefing up its data centers, Zoom has also been increasing its capacity with its two cloud infrastructure providers, such as Amazon Web Services and Microsoft Azure. And this was said by Steckelberg, and he's their CFO of Zoom. And then also on March 4th, Steckelberg told Analysis to expect a gross margin to be at the lower end of our long-term target of 80 to 82% for its 2021 fiscal year. Even after spending to add more capacity, Zoom is still comfortable with its guidance. And then according to the CFRA report, it is a 3-star rating for stock. And that was, I found that on 11/10/20. And that means it's a good rated stock. And they also say this stock is a hold, just basically meaning you don't want to buy or sell right now, just kind of hold on to it and see what happens. And then the economic and industry outlook, for the economic reasons, I mean, this is a very favorable stock to purchase right now, especially during the pandemic and COVID. Again, like Christine said, we're using this a lot from home. Teachers are using this, work. It's a necessity right now just to get by. And this stock kind of was it hit the right place at the right time. Since its 52-week mark, I mean, it's boomed. So if you bought it then, you're a lucky duck. I'm jealous. And they're still hiring staff because they need to complete the rising needs, that more people want to use this platform. And then in the industry, COVID is helping this technology industry boom. Again, just the pandemic, need to work from home, do school from home. It makes it easier. And people feel more safe when they're at home right now. And then the bear perspective. So it has a high PE ratio, which is the price to earnings ratio. And the company only earning about, it says 70 cents, but after today's ending, I think it was between 74 and 75 cents or 78 cents a share, which is not that good. So the investors are making their money off the capital gains, meaning they bought the stock at, let's say, $100 a share, and now it's at, $4.75, and then selling it. So making that, and then popularity may decrease as a future vaccine will come out. It will make people feel safer to meet in person. And I think some people are really eager to have that person-to-person interaction, and they're tired of being all cooped up in their house. So it could affect the stock of Zoom. And then competition is also on the way. There's a telecom company, Verizon, just bought Blue Jeans Network, which is going to be a competitor. There's also Microsoft Teams. There's a bunch of other ones, like I would say 5 other ones that they're really competing with right now. And then WebEx, made by Cisco. That's another really popular one. And then recent demand surge is mostly from free users. So that in the long run isn't going to be that profitable. Maybe by they're making 70 cents, 75 cents a share. It's free. They have started charging some users, but more people are going to use the free version than the paid version because it's been free for so long. Why would you pay for it now? And customer growth that will be much less robust during that. Also, privacy and safety concerns. Their front and center is it could stall out the uptick in the paid customer growth. And then, a lot of people, like I said, are working from home, so they have information on their computer that they don't want Zoom to be able to access or be able to hack your computer, just like any other program or, software that you're going to take the risk on when downloading on your computer. And video conferencing is exceptionally competitive market right now, obviously due to the pandemic again. With its relatively low barrier to the entry, it's also not that, it's it's not that big in the market yet. There's just, it's very competitive, but just like not as many companies as, let's say, like healthcare industry. You know, there's a lot more companies in that. And also it's risky. It's a risky stock to buy. You don't know what's going to happen if the vaccine comes out tomorrow. You know, it might drop because people are thinking they're not going to be wanting to use Zoom anymore. And again, I mentioned no dividend. Personally, not a fan. And then beta, it's 1.1, and so, you know, one's the average. So it's pretty, or it's more, it's, the stock is more for aggressive buyers. So who wants to come in, make some money, and then sell it and leave. So basically, to sum up our presentation, does Zoom belong in your portfolio? And thanks, guys. Thanks for listening, and we'll see you soon.